Welcome to the daily update, where I'll go over the action in the market for Tuesday, August 27th, and then we'll see how things look for Wednesday, August 28th. We're still positive. We're still looking vulnerable. We're still below average with volume. We have NVIDIA due to report earnings after the close on Wednesday, and there's a lot of anticipation in that right now. But there are some signs that are producing some concerns, and I'll go through those charts and show them to you. But in the short, intermediate, and long term, we still continue to be positive. There's a thing called the SPXInvesting Program. It is currently free. If you want to access that, there's a link in the description below this video that will take you to the website, as well as to some videos that talk about the program. If you are a member, you get access to the daily and weekly videos as soon as they are uploaded, which is before everybody else gets access to them on YouTube and Rumble. So that might be advantageous to you. If that interests you, please feel free to check it out. If you have any questions, please feel free to send me an email. The daily video is the real foundation of the analysis that I do. All of the other videos are meant to tie into the analysis that we do here in the daily video. So let's go back and talk about what happened. We did have a lower open at S1 at 55.96. So we opened below that 5,600 level. Not really an important technical level, but more psychological. And the financial media, oh, below 5,600, But that set the intraday low. And we were able to advance and get above the unchanged level and the daily pivot at 56.24, but we hit resistance at 56.30. That's what's happening right now. Both in Monday and Tuesday session, we're not necessarily hitting pivot points. We did right at the open on Tuesday, but we're hitting these round numbers before things seem to hit either support or resistance. Then as the day went on, prices declined back below the daily pivot and the unchanged level, so we went negative. But we found support at another round number, 56.10, before climbing back to 56.30 again, and then closing slightly above the daily pivot. We were up 0.16%, so really choppy on below average volume here. And we are positive in the short, intermediate, and long term. There are some vulnerabilities I'll go through and show you in the charts, but we continue to look positive, and there's great anticipation ahead of NVIDIA reporting their earnings after the close on Wednesday. Geopolitical events, things might be calming down, at least for the time being, in the Middle East. That's pushing oil back down, but that could re-escalate at any time. That's a real volatile and unstable part of the world where things could happen very quickly. But it doesn't seem to have really any impact on the markets right now. They're just ignoring what's going on. Some comments. Mega caps and semis outperformed. That's really what kept the market looking a little bit better in Tuesday's session. Oil declined as things may be calming in the Middle East. Now, that's probably short term. The mass index, we're still wondering. It's generating a signal. All of the components came together, and we were going up when that signal was being formulated. Now that it's triggered, does that suggest that we might see a reversal? Again, we don't want to use this chart independent of other charts. We want to look at the bigger context to see what's actually going on. Our short-term list, we still have the 20-period exponential moving average that we put right on the S&P 500. The rate of change going back 10 periods, the slope oscillator, Stoch RSI, the Williams percent R, stochastics, the boom indicator based on 20 periods. And we declined a little bit, but the 20-period moving average study, that seemed to kind of stick out to me in yesterday's video, and it's what I've been watching. We're still getting a very high reading, but we were up at 90%, and that's pretty extreme. In the intermediate term, we're back with the balance of power being extreme. The TTM squeeze just keeps going up for right now. The PMO studies, as well as the Chaikin money flow, the Sean trend meter. We got to love these acronyms. The money flow, and then the 10-day moving average of the S&P 500 highs minus the lows. In the long term, still looking extreme with the 200 and 150 simple moving averages. And no changes to the scenario right now. We'll see if something changes, especially in Friday's session where we're going to get core PCE coming out. But the Fed has pretty much come out and said they're going to do a rate cut in September. It's not that they're going to do it, it's by how much. The dollar was down, but interest rates were up. We just ticked up slightly to 3.83% with the 10-year yield, where we had been at 3.82% after Monday. And then we're still inverted with the yield curves, keeping an eye on those and seeing if the employment situation is showing some weakness. That's kind of the area that the Fed has been using to justify keeping rates higher for longer. If we see employment start to wane, that could send the yield curves back to being normal again. And then that's when we start a countdown, usually 5 to 6 months or so, to see if we end up going into a recession. But the market is anticipating that that is not going to happen. That, yeah, we might go back to looking normal with the yield curves, but they're identifying this now as a soft landing, which means we will not have a recession. We're neutral right now with sentiment. It was unchanged at 53, where we had been at 53 after Monday. And then we are still looking at the ADX weakening. It's still dropping down. It hasn't dropped below 20 in the intermediate term. It's below 20 in the short term, and that suggests a non-trending environment. However, we are positive. The green line is above the red line. With the slight update, our bias is positive, and I'm still keeping our momentum at positive for the time being. All right, economic reports. We had consumer confidence come in greater than expected at 103.5. They expected it to come in at 100, and it's also up from the 101.9 we saw last time. The FHFA Housing Price Index was down 0.1%. Last time it was unchanged. The Case-Shiller Home Price Index came in up 6.5%, more than the 6% they had expected, but down from the 6.9% we saw last time. So looking at this chart, this is the month-over-month chart for the house price index, where it actually is showing a decline here. And here's the FHA house price index on a year-over-year basis, where it's starting to decline a little bit according to this chart, where the Case-Shiller home price index continues to go up. So they have completely different ways of measuring this, but they come to different conclusions. All right, then looking at consumer confidence, the total reading is here in blue, which is a little bit above 100. And then how do people feel right now? That's purple, just a little bit of a tick up. Maybe they had a nice barbecue or a good trip to the beach. And then looking out into the future, they're actually looking a little bit more positive, but it's still well below this optimistic level because there's just a lot of things to be concerned about in the world right now. Isabel Net blog charts, the overbought, oversold composite. As we've been bouncing back up, we're getting into the 85 range. Usually it's when we get above 90, but anytime we're above 75, that's when the market is considered to be looking extreme positive. Short interest, and I explained this, there's a couple of different ways to look at this. If there's a lot of short interest, whether it's in a stock or an index, this is the short interest for the S&P 500. It's at 1.8%. That's not very high, but it's higher than it has been over the last few years. That's the negative side, because you figure, okay, if people are shorting the market, they must really know what's going on. But it also builds in some buyers on the sideline. Because if the market goes against these folks, they have to buy to get out since they had to sell to get in. Then on the other hand, we see short interest coming down because there's other vehicles, ETFs, and even mutual funds that you can use to take advantage of the market going down without assuming all the risk of an actual short position right on the index. Looking at the consolidated equity positioning, starting to go back up a little bit here after it had been coming down as the market was under pressure. And then mega cap growth and tech positioning also continuing to come down a little bit lately. And then households and investors have missed the rally to all-time highs. This is looking at gold, where we look at the spot price. This is the cash price for gold. It's been going up as the ETF gold holdings have actually gone down, and that's the GLD. That's what I follow mainly over the weekend. I go through that in the intermarket analysis video, and it's just suggesting that the gold's been going up as people have been getting out of that ETF. And then global fund flows showing that a lot of money is still going into cash. We have money going into bonds as they become more attractive now, as interest rates are potentially starting to come down. And then equities, which are stocks, still seeing an awful lot of money going into that area of the market as well. And then dollar weakness has come alongside a recovery in risk sentiment and higher equity prices. And that's what I talk about. And I go through this saying if the dollar's down, that typically gives support to stocks because the market likes a weaker dollar. And that's pretty much what we're seeing right here is the DXY. That's one of the dollar indexes. I follow the USD. That has been going down as the S&P has been going up. And then the economic surprise starting to tick back up a little bit, but we're tending to see more weaker than expected economic reports than stronger. And this is probably okay for right now. It's when we get really extreme positive surprises or negative surprises, that's when it starts to really wreak havoc on the market. But there could be like core PCE could come out on Friday, not necessarily show up that much in this chart, but really rattle the markets. And then I think it was in yesterday's video, I showed the US debt, and it's just astronomical. Well, believe it or not, there's countries that even have a worse debt to GDP ratio. And Japan is at the very top of the list. And then you have the UK, and we have Europe. And then the US is actually in fourth place. When as much debt as the US has, there are other countries that have a lot more, and then emerging markets are, I mean, all of these, it's kind of a dangerous environment right now, but it still seems to continue and it doesn't seem to really bother the markets. Couple of charts here. This is put out by Lance Roberts at Real Investment Advice. He posted this chart saying hedge funds. Now, I usually don't pay a lot of attention to hedge funds because I consider them to be the big money, but not the smart money. But since we're in a below average volume environment, and this just means that if hedge funds come in and start to do something, they may have an impact on the market. It just says they're back to selling stocks like they were in July, just prior to the downturn. And you can see right over here, they are doing a lot of selling right now, and that could have an impact on the market. And then this is sentiment in the dollar. It's become really extreme negative right now, which could end up giving some support to the dollar. And it's been under pressure, and that's been helping stocks. So if we see hedge funds come in and start selling and continue to do that, the dollar possibly getting extreme negative, starting to go up, that could also pressure stocks. So taken together, these are some areas that might have some problems, at least in the short term, as far as the S&P 500 is concerned. Then here's our chart where we did gap lower, but that we set the low right here at the open. We got down to S1, and then we came up above the unchanged level, got above the daily pivot, and then hit twice, and not just twice, but consistently hit this 5630 level as overhead resistance. We came back down, went back up, could not seem to get above that level, and then did close a little bit above the daily pivot. No real changes now. Things are a little bit quiet and in anticipation of the NVIDIA earnings coming out. This is still a concern to us where we see the red line above the blue line. That means the value is outperforming growth on an intraday basis. And not seeing much of an improvement here with the growth to value ratio intraday for the S&P. And so growth was up more than value, but growth was down more for the mid caps and down, but not down as much for the small caps. So we're seeing a continuation of a decline with small cap growth to value, a little bit of a tick up after really declining with mid cap growth to value, and a little bit of a tick up, but no real strength right now with S&P growth to value. Looking at this growth versus value ETF, we're still inside of the rainbow, not really showing any true conviction right now. And ticking back up, showing some improvement, but not really breaking out when we look at this discretionary versus staples equal weight ratio. Large cap growth was up and still above its 50-day moving average, so that's holding on for right now. We ticked back up here with large caps outperforming small caps, and so this is starting to go back up. And when we see this ratio really going up, that just means the large caps are leading things higher. And then we look at the condition of the trend. We're not down to 20 yet with the intermediate term chart with the ADX, but we continue to be below the moving average. and the green line is on top. So that's why we still default to positive, or we have dropped below 20 with the short-term ADX, but the green line is still on top. So it's still positive in the short and intermediate term. And we continue to drop off with volume as we're leading up to Labor Day weekend here. Coming down and getting to quite low readings again with the Ulcer Index. We did decline with the VIX, with the line chart, as well as the bar chart. So we're not seeing a real spike in fear there. And when the VIX is down, we also see the VIX of the VIX also continuing to decline. The momentum of the VIX continues to be negative. This is an updated, well, it should have been updated. I have another chart here that should have been included here. We saw the big spike up right about here in August when really the VIX should have been going down. But on a seasonal basis, we do see the VIX rising as we go into September and even into October, and that could pressure stocks as well. The SKU index is still up in this red area now, so the market is anticipating some kind of move. Maybe it's rather fitting that it's anticipating that ahead of NVIDIA. And who knows? I mean, if NVIDIA has a earnings report that is well received, the market could really shoot higher. If they disappoint in any way, shape, or form, the market could go lower. But there was a few months or few earnings times, quarters, I guess, one or two ago, when NVIDIA just came out with a killer earnings report, gapped higher, and then we just tanked after that. So we want to be aware of those things, buying the rumor, selling the news. But NVIDIA has been pretty flat the last couple of sessions. We'll look at that chart coming up here. We are going up with the equity put call ratio, so there's some additional hedging going on. We continue to go up with the 5-day chart, and it's hard to see, but we're starting to turn back up here with the 10-day chart. As folks are a little bit nervous, possibly ahead of NVIDIA, possibly ahead of the Labor Day weekend, possibly ahead of any potential escalations, not only in the Middle East, but between Russia, Ukraine. There's things between China and the Philippines going on. There's an ongoing thing between China and Taiwan. Any one of those things could explode at about any time. And so hedging is probably a good idea. And we're looking at the spread between risky and not as risky bonds. This is continuing to go up, which means fear is dropping off. And that's more positive for the market. And we ticked up a little bit with this fear gauge, but we continue to go lower with this other fear gauge. So a little bit of a contradiction there. And we look at the risk on to risk off ratio, tick back up a little bit after it really had been declining. To be more positive, we want to see this ratio continue to go back up and show some conviction, but it's not really doing much right now. Volatility risk premium still very low. It had been bouncing up, but we're well below this band. Still looking okay, even though we were flat with the advanced decline line based on price, also flat based on volume. Where we broke out to new highs here with price, we have not been able to break out based on volume. That's a slight negative divergence. But we're still looking okay here with our new highs, new lows. We saw a real spike up in Monday's session with that gap higher open. And if we had seen a positive open on Tuesday, we would have seen the new highs be generated, but that didn't happen. But we're still seeing a lot more new highs right now than we are any new lows. So the 5 period and the 10 period continue to go up. And we're looking at the accumulation distribution, pretty much, well, we're positive here. We're going up just a little bit with the moving average going up. The boom indicator is still looking a little bit extreme. And the advanced decline ratio actually declined after being extreme positive. We ticked down just a little bit with the 39-day as well, but these are still positive. Based on price and volume with the advanced decline ratio, we are coming down. So seeing a little bit of a pullback there. And this was a concern that I brought up after Monday. We started to come down with the chicken money float. Now we were able to go back up and the red line's going up. So this has turned back to looking more positive. But this is still a concern. Even though we ticked up a little bit with the chicken oscillator, the fact that this has been going down, even as the S&P was going up, that is a concern as well. And the vortex is positive, but I've been watching the red line down here, and we're getting to kind of an extreme negative reading. And we're still looking pretty good here with the S&P 500 advanced decline line cumulative based on price. That continues to go up and setting new highs, but we're not breaking out here based on volume. We're still looking good a little bit longer term with the 10-day average of the highs minus the lows for the S&P. That's giving us a good solid reading. And when we look at the NYSE cumulative advanced decline line, we did decline, but we're still above the moving average here. And we continue to go up with our regular advanced decline line, even though it ticked down a little bit. This other NYSE advanced decline line ticked down, but is still looking pretty solid. And then we look at the common stock on the NYSE. It ticked down just a little bit, but has been breaking out. And we're seeing that confirmed here with volume. Then we did come down a little bit with the S&P and rolled over a little bit with the NYSE advanced decline line, but still looking pretty solid here. In our advanced decline line studies, coming down across the board, but still well above the moving averages and holding up rather well for the time being. So here's our daily chart. Really not much to talk about here. We might have some overhead resistance at this daily pivot. If we go up, we'll be keeping an eye on the 50-day moving average if we start to fall, at least on this chart. You can see volume just dropping now, and then that can make the market more vulnerable. The condition of the 20-period moving average is still looking pretty solid here, and we're above both the simple and exponential moving averages. We're above all the plotted moving averages here on our moving average tree. We're still extreme positive with the 20-period exponential moving average on the S&P itself, even though it did decline. We're no longer extreme with the 50, and we turned down just a little bit with the 200. We're still extreme with the boom indicator, seeing that we're kind of far away from that 20-period moving average. Still looking okay with the 50 and 200. The Stochk RSI declining, but still extreme positive. Still extreme with the Williams percent R. We're not extreme with the CCI 14 or the CCI 20. We're still extreme in the short, intermediate, and even the long term with our stochastics charts. The force index declined, but it's still positive. And we're in the +2 channel with our standard deviations chart. That's not extreme. And this is where I was saying we came up to that 90% level, rolled over just a little bit. We're still getting a very high reading here. Now, this could go up higher than it is, but it would just become more extreme. And this, on one hand, suggests good short-term momentum. On the other hand, it's like, wait a minute, maybe we need a little bit of a pullback to slow things down. And here's our study. We're still well above the 70 level for right now. We're coming in at 88. And we ticked down with our 50-period moving average study, came down a little with the 100, and we came down with the 200. But all of them are still positive when taken together. We're back to looking extreme with the balance of power. And the condition of the 50-period moving average, still looking pretty solid there. We're still above both the simple and exponential moving averages. And we're still looking positive here with the go, no-go system. And we're coming up just a little bit below the highest high blue line here. That's still looking positive. And why do I have another chart here? Well, I guess if you didn't get the go, no-go before, you get it again here. TTM squeeze is still continuing to go up, and it's well above this black line. And to give it a little bit more context, this is a pretty high reading right now. And look at other times when we had a high reading, that often marked a top. Not necessarily right here, but other times it did. So we want to pay attention to this. The standard deviation, as we're been chopping sideways, the last 10 periods are really slowing down, and we're coming down with this reading. If we drop below the moving average, I'll probably discontinue showing this chart until it says something again. We did decline with the ease of movement, but we're still above zero. And we're coming down, but still positive with the S&P McClellan oscillator. So we're going up based on price and volume. Yes, we see the longer-term negative divergences here compared with price, but we're seeing price and volume confirm each other for right now in the shorter term. We also declined, but we're still positive with the NYSE McClellan oscillator. So we're going up with the summation index based on price and volume. The Erin is pretty much flat, but is still positive. And this is another area that's been a concern. We are coming down a little bit here with the Swenlin trading oscillator based on price and volume. We're still positive, but the fact that this is going down is kind of concerning to us. But on a momentum basis, we continue to be positive with the PMO, and we're also positive based on price and volume. We're no longer extreme positive with the PMOs that are rising, but we are extreme with the buy signals, and we continue to go up with the PMOs above zero. And we're neutral with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR, which is also being confirmed by the weekly chart. Slope is above this green line, looking extreme positive, but it's still positive nonetheless. The MACD continues to be positive. So we are positive, but possibly extreme in the short term with the slope and TSI, not extreme, just above the midpoint. But we're looking positive with our intermediate term oscillators and our long-term oscillators. We came down, but we're still in this somewhat extreme positive territory for the Sean trend meter. We actually ticked down a little bit with the bullish percent index, but we're still looking pretty solid there. We're going up with the NYSE bullish percent index, and we're no longer extreme with the NASDAQ 100 bullish percent index. It pulled back. We are extreme with the money flow, and we're coming back up with the ultimate oscillator and above 50. That's positive. And we're just chopping around here with on-balance volume, but we're still above the moving average, and the moving average is going up. We're still above 50 with the RSI 14 and 9. So that's hanging in there for good momentum. And the copy curve, another momentum oscillator, continues to be positive. We're wondering now, all of the parts of the mass index have been signaled. We're wondering if that's going to point to a reversal. There, you could point to possibly a double top here. And I know the perma bears are just drooling over this, but there's too many variables yet that could break the market either higher or lower before we're ready to say that this is a double top. The Pring bottom fisher is generating a buy signal right now, even though it came after a decline. And we are, looks like, starting into a new 50-day cycle here. But again, I don't rely on this because you have to use hindsight for this to really make sense. We're still looking good here with our weekly chart of the S&P. We're above this R2 level. But we're still below the 61.8% fib extension level for the S&P. And when we look at our different charts, looking a little doji-ish here. That's a little indecisive, but we're positive overall with the Heiken Ashi. We're positive with the Kagi chart, positive with the Renko chart, and continue to be positive with the three-line break chart. And looking at the point and figure chart, we didn't have enough. There was enough in Monday's session to generate a new green X here. We're just kind of coming back and matching this all-time high. Our long-term chart, we're still looking a little extreme with the 150 and 200 period moving averages. And we're positive across the board with the Keller market model on all time frames across all indexes. And we've switched over to commodities being in a short-term uptrend where they're still negative in the intermediate and long term. The dollar is still negative on all time frames. We're still looking good across the board with the decision point scorecard. And we saw where tech was up, and that helped the day be a little bit more positive. And then financials, which still continue to be quite positive. Energy was down and utilities were down the most. And then we saw another decline in discretionary. And we saw negative signals with the lower open. They were pretty much generated right after the market opened on Tuesday. Then later in the day, we had the healthcare, which is a defensive area. The BPI did cross above 70. And we're coming down a little bit, but still looking good when we compare the S&P to the S&P equal weight index. This ratio did go up a little bit as the big stocks had a bit of a better day than the rest of the S&P 500. We're still looking good here with our raw score of the new highs minus the new lows for the NYSE. And this is positive in that we're setting a new all-time high here with the equal weight S&P 500, but we're not seeing that confirmed by the QQQ equal weight, and that's a negative divergence. We want to see, and who knows, maybe the NVIDIA thing will be able to change that. And we look at the equal weight versus the S&P, a little bit different way of measuring this. We actually declined a little bit. Here's the equal weight slightly underperformed. Really not a big change with the Dow. Was up slightly, but 0.02%, virtually unchanged. And the diamonds have gone from being positive over to neutral, where we're still dealing with the 50-day moving average with the NASDAQ and the NASDAQ 100. We're neutral with the Elder's Impulse system for the Qs. The momentum is still positive for the NASDAQ 100, but starting to show a little bit of weakness. And we're just a little bit above the 50-day moving average here with the QQQs. And looking at the fib extensions for the Qs, we're still above this 23.6% fib extension level. Small caps were down a little over 0.5%, but still looking good here with the Russell 2000 small caps declining, but still above 50 with the RSI, still above the 50-day moving average. The momentum in the short term still continues to be positive. And we've gone from positive to neutral for the small caps with the Elders Impulse system. And we look at the ratio here where it declined with small caps to tech, as tech had a better day than small caps. The mid caps were down 1/3%, but still above this pivot level here and still above its 50-day moving average. And we've gone from being positive to neutral for the mid caps. The Wilshire was up just a little bit, but still is above its 50-day moving average. All stocks were also up just a little bit and still looking fairly solid for the time being. The staples to tech ratio ended up declining. That's more positive for the S&P, but we want to see more of a decline than what we're seeing right now to have the tech sector start to outperform. Financial sector still looking good, up another 0.5%. And the FANG index is still below its 50-day moving average. Apple was up 1/3% above its 50-day moving average. Amazon is coming back down and testing its 200-day moving average again. Microsoft also potentially coming down to its 200-day moving average. Google is right in between and was down 0.89%. Meta, which was down 0.39%, still above its 50-day moving average. And NVIDIA up 1.46% above its 50-day moving average ahead of earnings coming out. And Tesla's coming back down and testing its 200-day moving average, but still in a longer-term uptrend. Netflix is also looking good, up 1%. When we look at the broad market and look at a 5-period moving average of the highs minus the lows, we continue to be positive here. Oil is dropping back down into the mid-70s, and the dollar ticked up just enough here, but we're still working off of a recent death cross here on the daily chart. We're also working off of a recent death cross on the weekly charts. And we're still seeing where the short and long-term correlation between U.S. stocks and world stocks continues to be strong. We were just not really much of a change, but up with the 10-year yield. And we were down slightly with the 10-year based on price. And looking at the growth to value ratios, not really seeing anything all that strong here with the Qs to S&P, discretionary to staples. Large cap growth is underperforming large cap value. So the large caps, mid caps, and small caps are just not taking any kind of a leadership role. We did go up slightly here with the S&P to utilities ratio, but not really showing any conviction right now. And then the staples to S&P did go up just a little bit. We want this to go down for the S&P to be more positive. So what's our outlook for Wednesday? Just keep in mind that the market will be closed on Monday, September 2nd for Labor Day, the last 3-day weekend that marks the unofficial end of summer. NVIDIA will come out with their earnings after the close on Wednesday. And we are now positive, but we're overbought. And we're still dealing with this below average volume. And in the short term, we're still extreme, even though we came down just a little bit there. We're going to just have the MBNA Mortgage Applications Index. That's it. And that's a weekly report and not a real market mover. And then all the different geopolitical things that I mentioned earlier, at any time they could escalate and actually have an impact on the market. And then on Thursday, we're going to get the GDP second reading, as well as the jobless claims, and then core PCE is going to come out on Friday. And here's another look at the economic calendar. Seasonally, this is one of the more positive days of the whole year, where we have the Dow, S&P, and NASDAQ really positive, 85.7%. Now, this is from 2002 to 2023, over 90% up with the S&P and 81% for the NASDAQ. But then Wednesday is usually the most negative day of the week. And Wednesday is performing a little bit better so far in 2024. And we do see some positive seasonality here, but then we see some negative seasonality after that. And then this is a more updated chart here. Also seeing not really the great seasonality that the statistics do when you just break it out based on an election year. And then comparing all years of the election and how it tends to be more positive, but when there's an open field, which is what we have now, that tends to be more negative, especially when we get into September. And August tends to be good. This is an updated chart, but September tends to be more negative, and sometimes October can even be negative. And September, that's another thing that we're kind of watching out for now. And when we take August through October, we tend to perform negatively going back to 1928. But August looks pretty good during an election year, but September looks bad no matter how you try to calculate it. And then trying to compare what happened in 2023 with what's now happening in 2024, we're kind of sticking to this a little bit close, but we did see some weakness going into the latter part of October in 2023. So we're keeping an eye on these different defensive sectors. I feel like a broken record saying this, but we've got staples doing well, utilities doing well, energy did pull back, and healthcare has been doing well. And these are more defensive areas. This is what the market usually gets into before it's ready to see a decline. Both the 5 and 10-day equity put call ratio charts are going up, and that's more negative. And growth of value as well as discretionary to staples just not helping the market right now. Still have a pretty long list on the positive side, the accumulation distribution, but the boom indicator is still looking rather extreme, even though it declined a little bit. The Chaikin money flows back to more just flat positive, where the Chaikin oscillator, it ticked up a little bit, but overall it has been declining lately, and that's a concern. The advanced decline lines are still looking good, as are the S&P and NYSE McClellan oscillators and summation indexes. The Swenlin trading oscillator, it is declining, even though it's still positive. The parabolic SAR is positive, confirmed by the weekly chart. Our oscillators are positive. The bullish percent indexes for the S&P, NASDAQ 100, and NYSE. And the ease of movement, the money flow, the ultimate oscillator, the Copic curve, the vortex, but we're still a little concerned about that red line going down too far. And the financial sector continues to be positive. And the momentum for the NASDAQ 100 is also positive. So our conclusion, we're positive, but we're overbought, and we still have to deal with this below average volume. In the short term, even though we came down with that 20-period moving average study, it's still pretty extreme. However, we remain positive. We're also positive in the intermediate term, but still seeing some extreme positive or overbought indications. We're also positive in the long term, but we still have the 150 and 200-period moving averages looking a little extreme there. So thank you. I hope you have a very good day, and I will talk to you in the next video.